Most people who start trading lose money. It's a harsh reality, but it's the truth. The allure of quick riches often blinds newcomers to the inherent risks involved. Many enter the market unprepared, driven by emotion rather than a sound strategy. It's almost a rite of passage, a trial by fire that separates those who are serious about learning the craft from those who are simply gambling. This initial period of losses can be discouraging, but it's also a valuable learning experience. You see stories of overnight millionaires plastered across social media and financial news outlets. These tales of rapid success fuel the dream of instant wealth, and think, I can do that. The market seems like an easy way to get rich, a shortcut to financial freedom. The promise of quick gains is incredibly tempting, so you jump in, buy a hot stock without doing your research or understanding the underlying risks. You're relying on gut feeling and hype rather than informed analysis, and watch your money disappear. The market turns against you and your initial investment dwindles before your eyes. The dream of quick riches quickly turns into a nightmare. Why? What went wrong? Where did I mess up? Because most beginners have no plan, no strategy. They're essentially flying blind, making decisions based on hunches and rumors. Just hope. They're hoping for the best, but hope is not a strategy. Hope is what you cling to when you have nothing else. They treat the market like a casino, a place to gamble and get lucky. They're chasing the thrill of the win without understanding the odds. Chasing tips and hype, blindly following the crowd without doing their own due diligence. They're susceptible to misinformation and manipulation, buying high, panic selling low. They buy when everyone else is buying, driving the price up, and sell when everyone else is selling, driving the price down. The market is complex, a dynamic system with countless variables at play. It's not as simple as buying low and selling high. Driven by forces you can't control, global events, economic indicators, and political decisions can all have a significant impact on market prices. It doesn't care about your feelings. The market is indifferent to your hopes, fears, and dreams. It operates according to its own rules. The real problem, new traders think there's a secret shortcut. They believe there's a magic formula or a hidden strategy that will guarantee them success. There isn't. There's no easy way to make money in the market. It requires hard work, dedication, and a willingness to learn. The good news? You can learn to avoid catastrophic losses. You can develop strategies to protect your capital and minimize your risk. It's not about magic formulas. It's about changing your mindset. It's about developing a disciplined and rational approach to trading. Treat trading like a business. Have a plan, manage risk, make decisions based on logic, not emotion. You will have losing trades. The goal is to make your wins bigger than your losses over time. This guide will break down the essential rules every successful trader follows. Forget the Lamborghinis. Focus on not losing all your money in the first week. That's your first real win. Before you trade, you need a written trading plan, no exceptions. Trading without a plan is like building a house with no blueprint. It's guaranteed to collapse. Your plan is your rule book. It keeps you from making emotional decisions. Define your goals. Are you day trading, swing trading, or investing long-term? Set specific entry criteria. Don't just buy because a stock looks good. Establish clear exit rules for both profits and losses. Know your stop loss before you enter. Include position sizing and risk management. Never risk more than 1 to 2% of your capital on a single trade. Write it all down: your strategy, entry and exit signals, and risk rules. When the market gets wild, follow your plan, not your emotions. This is what separates pros from gamblers. Stick to your blueprint. In the world of trading, where fortunes can be made and lost in the blink of an eye, risk management is paramount. If you ignore stop losses, if you neglect this crucial tool, you're almost guaranteed to fail. It's not a matter of if, but when. The market doesn't care about your hopes or dreams. It only respects those who respect its inherent volatility. A stop loss is your automatic safety net, your predetermined exit strategy. Think of it as an insurance policy for your trades. It limits your loss before it spirals out of control. It's the difference between a manageable setback and a catastrophic wipeout. It's about protecting your capital so you can live to trade another day. Example, buy at $100, you see an opportunity and decide to enter a position. Set a stop loss at $95. This means you're willing to risk $5 per share on this trade. If the price drops and hits that $95 mark, you're out with a small manageable loss. The trade is automatically closed, preventing further damage. Without a stop loss, you're essentially gambling. You risk holding as losses grow, watching your account bleed and feeling the pressure mount, hoping for a turnaround that may never come. This hope can be a dangerous thing, clouding your judgment and leading to even bigger losses. A stop loss enforces discipline. It forces you to stick to your plan, even when your emotions are telling you otherwise, and protects you from emotional decisions. Fear and greed can be powerful forces, but a stop loss keeps them in check. Place your stop loss at logical levels. Don't just pick a random number out of thin air. Below support or a key moving average, areas where the price is likely to bounce or reverse. Not just a random number. Base it on sound technical analysis and market understanding. Once set, never move your stop loss further. Don't widen it in the hopes that the price will turn around to accommodate a bigger loss. This is a classic mistake that can lead to devastating consequences. Respect your stop loss and it will save you. It will protect your capital and allow you to stay in the game again and again. It's a fundamental principle of successful trading. Decide your risk before you trade. Determine how much you're willing to lose on a particular trade before you even enter the position, not in the heat of the moment. Don't let your emotions dictate your risk management strategy. The market is unpredictable. It can turn on a dime and black swan events can happen at any time. Your stop loss is your defense. It's the shield that protects you from the market's unpredictable nature. Make it non-negotiable. Treat your stop loss as a sacred rule that you never break. Every trade, every time. No exceptions, no excuses. That's how you survive and ultimately thrive in the long run. That's how you build a sustainable and profitable trading career. The urge to go big is strong. The allure of massive profits, the dream of instant wealth, it's a powerful draw. We see the headlines, the success stories, and it's easy to get caught up in the excitement. But starting small is how you survive, especially in the unpredictable world of trading. It's about building a foundation, learning the ropes, and protecting your capital. Trade with amounts so small that the potential gains or losses don't trigger emotional responses. They feel almost insignificant, like pocket change. But these small trades are your tuition, your investment in your trading education. Your goal as a beginner isn't to make money, not yet. It's to learn the market dynamics, understand your own risk tolerance, and develop a sound trading strategy. It's about absorbing knowledge and gaining experience, and crucially, avoid big mistakes that could wipe out your account before you even get started. Think of it as flight training. Start in a simulator, where you can make mistakes without catastrophic consequences. Not a jumbo jet, where a single error could lead to disaster. Risk just a few dollars per trade, a tiny fraction of your overall capital. If you lose, it stings a little, a reminder to analyze what went wrong, but it won't wreck you, it won't derail your journey. You'll live to trade another day. Small losses let you focus on your process, on refining your strategy and improving your execution, not your emotions, which can cloud your judgment and lead to impulsive decisions. Build good habits from the start, disciplined risk management, consistent analysis, and a commitment to continuous learning. And test your strategy rigorously, back-test it, forward-test it, and adapt it as market conditions change, without risking your future, your family's security, or your long-term financial goals. Once you're consistently profitable, demonstrating a clear edge in the market, on a small scale with a proven track record, slowly increase your position size, gradually scaling up your risk as your confidence and profitability grow. Prove you can follow your rules, even when the stakes are higher and the pressure is on, before you scale up significantly, ensuring that your risk management and trading discipline remain intact. This methodical approach, this patient and disciplined strategy, builds real skill and confidence, the kind that lasts and allows you to thrive in the long run. Don't rush the process, don't skip steps, and don't let greed cloud your judgment. Earn the right to trade bigger by consistently demonstrating profitability and responsible risk management. Survive first, protect your capital, and learn the game. Thrive later, when you have the skills, the experience, and the discipline to succeed. That's the path to sustainable growth, the path to long-term success in the market. The 1% rule is your ultimate shield. Never risk more than 1% of your capital on a single trade. With $10,000, your max loss per trade is $100. With $2,000, it's $20. This rule keeps you in the game, even through losing streaks. If you risk 10% per trade, just 10 losses can wipe you out. At 1%, it would take 100 losses. Calculate position size so your stop loss equals 1% of your account. Example, $10,000 account, $2 risk per share, $100 max loss equals sign 50 shares. The 1% rule forces discipline and selectivity. You'll focus on high reward, low risk trades. No single trade can destroy your account. The market is uncertain. Protect yourself from the unknown. Professional traders survive by managing risk, not chasing wins. Make the 1% rule your foundation. It's how you last. So, the market is designed to trigger your emotions: euphoria on green days, panic on red. Acting on emotion is financial suicide. Panic selling and FOMO buying are the fastest ways to lose money. Trust your trading plan. If your stop loss isn't hit, don't sell in a panic. Don't chase hot stocks just because everyone else is. Only trade setups that meet your predefined criteria. There will always be another opportunity. Don't let FOMO dictate your trades. Reduce noise. Stop watching every price tick. Set alerts and walk away. The less you watch, the less likely you are to make impulsive decisions. Calmness is a skill. Practice it. Your plan is your anchor in a storm. Trust your preparation, not your emotions. That's how you stay in control. In trading, mistakes are inevitable and essential for growth. The difference between failure and success is what you do after a mistake. Keep a trading journal. Record every trade, what you did, why, and how you felt. Review your journal regularly. Look for patterns in your behavior and results. Most losing trades come from breaking your own rules. Identify and fix these habits. Each loss is tuition for your trading education. Use your journal to refine your strategy and add new rules. For example, if you lose money trading at the open, add a rule: no trades before 10 a.m. Turn every mistake into a lesson. Without reflection, you'll repeat the same errors. With it, you'll improve, one trade at a time. That's how you get better. Emotional control is the biggest challenge in trading. The market preys on hope, fear, greed, and regret. Successful traders execute their plan with discipline, not emotion. Hope makes you hold losers. Greed makes you overstay winners. Kill hope when a trade goes bad. Take the loss and move on. Take profits when you hit your target. Don't let greed erase your gains. Trust your system, not your feelings. Focus on flawless execution, not the outcome of any single trade. Over hundreds of trades, discipline wins. Detach emotionally, trade like a pro. That's the secret to consistency. Let's bring it all together. Trading success isn't about secrets. It's about discipline and risk management. Most beginners lose because they skip the basics. The rules: have a written plan. Use stop losses, start small. Manage risk with the 1% rule, stay calm, learn from mistakes. These aren't suggestions, they're survival. Your plan defines every move, your stop loss protects you. Small trades build habits, risk rules keep you in the game. Trust your plan, not your emotions. Keep a journal, refine your strategy, and improve every day. Trading is a marathon, not a sprint. The winners aren't always right. They manage losses and stick to their plan. Protect your capital, follow your rules, and let the process work for you.